Good afternoon, everybody. I'd like to thank you for taking some time out of your busy schedules to spend some time with the MTRS learning about your MTRS benefits. I'm going to be presenting as one of the presenters here today. My name is Scott Cawley. I'm the director of the Contact Center Services Group. And my co-presenter today is Christopher DeLisi. He's the assistant director in the Contact Center Services Group here. Throughout today's program, we are going to be covering and giving you a really nice introduction to the retirement system and going through everything that you would need to know about your benefits through the MTRS. So give you a nice introduction as to who we are and what we do, some resources for our membership, talk about your annuity savings account, which is simply the account that you have here with the MTRS, where all of your retirement contributions come into us. We track that money throughout the course of your career, and that's the money that the state is investing to make sure that they can pay you a lifetime pension. We're going to focus on your benefits, go through the eligibility criteria that you have to meet to make yourself eligible for a retirement benefit, talk about your creditable service, how you can increase your years of creditable service through service purchases, and we're going to focus on the benefit calculations for everybody. We'll cover in detail the 3 options for retirement, how the retirement formula works, and go through some sample calculations, which I always find helpful in explaining the benefits to our members. We'll also, at the end, talk about some retirement issues and things that you need to be considering before you retire and after you retire. Through the program today, we do have a chat feature, and we have some staff members here to help answer chat questions from everybody. We had 1,808 people register for our program as of yesterday, and we are going to try to answer as many of the chat questions that we do receive. During the program itself, myself and Chris will stop at a few different sections in the program, and we ourselves will answer some questions that we pick out from the chat that we think would be the most helpful questions for a large audience. At the end of the program, if you have not had your chat question answered, or if you do have any additional questions, you can send an email to our GenInfo email address. And that's GenInfo, GENINFO @trb.state.ma.us. Now, there has been some recent legislation passed that helps. It's really an opportunity for members of our system that had a transfer in to the retirement system. So it helps people who transferred money from a local publicly controlled retirement system in Massachusetts between July 1st in 2001 and June 30th of 2022. This is some corrective legislation to help people that may not have taken the opportunity to elect in when they were able to after we received their transfer of funds from another retirement system in Mass. And it's for people who have not yet made or submitted that election. The new election period is going to begin on January 1st of 2023, and it ends on June 30th of 2023. So right now we are preparing the form that people will use to be able to make their election and information that will be going out to our membership. There is information on our website, just our main publicly facing website, mass.gov/MTRS, which is helpful. So if you do think that you may be impacted by this, I definitely recommend going on to our website, but we will be notifying eligible members directly. Those who do not respond to this election period will not be enrolled in the Retirement Plus program. And please keep in mind this election opportunity does not include members who already had the opportunity to elect into the Retirement Plus program during the original election window, where they had to make an election prior to June 30th of 2001. This is simply for people who transferred into the MTRS from another mass public retirement system between July 1st, 2001 and June 30th of 2022. We do now have at the Mass Teachers Retirement System 2 membership tiers. So anybody who started contributing to our system prior to April 2nd of 2012, those members are what we refer to as Tier 1 members. But Pension Reform 3 that took place prior to 2012 created a new benefit structure for members of our system who entered membership on or after April 2nd of 2012. So for those members who entered membership after April 2nd of 2012, they do have a different construct in terms of their benefits. So members who entered after April 2nd of 2012, see here, just make sure it's not on that slide. They do have different age factors used in their calculations. Members who started after April 2nd of 2012 have to be at least 60 years old in order to retire from the system. And members who started on or after April 2nd of 2012 have a 5-year salary average period versus Tier 1 members who have a 3-year salary average period. It's your highest 3 consecutive years of salary used in your salary average for Tier 1 members and your highest 5 consecutive years of salary for Tier 2 members. So those are the main differences. If you do have any questions on Tier 2 benefits, we do have some slides throughout the, some information throughout the booklet, some side-by-side comparisons of Tier 1 and Tier 2 on page 25 of our benefits guide, an R+ percentage chart on page 27, and the age factors in R+ percentage chart on page 28. This program today is going to focus on Tier 1 benefits. But as I said, there is some additional information in our benefits guide. Everybody should have received the link to that in the registration email that we sent out to everybody for this program. So you can find additional information on Tier 2 benefits. Now to jump in here with the kind of information about our system, what is the MTRS? The MTRS is formed under Mass General Laws Chapter 32. That means that we have to go to the Mass General Laws and follow that section of the law that covers the teacher's retirement system. Mass General Laws Chapter 32 actually governs all of the public retirement systems in Massachusetts. We operate as a defined benefit plan under Section 401A of the Internal Revenue Code. That's something that's very helpful to know, especially if you're meeting with a financial planner. They will most of the time, or they should, ask what type of a plan is the MTRS. We're a defined benefit, 401A, and that means that there is a set formula used to calculate your benefits. When you retire from our system, we're going to assign an age factor to your age. We're going to multiply that age factor by your full years and full months of service, and that will tell us a percentage that you are eligible to receive of your 3-year salary average. And for Tier 1 members, that is your highest 3 consecutive years of salary. Please keep that in mind. It's not your highest 3 salaries, it's your highest 3 consecutive years of salary, which in most cases is somebody's last 3 years of employment. The best thing I can say about a defined benefit plan is when you retire from our system, your benefit is guaranteed for life. Okay, it is never going to decrease. It will increase over time with cost of living adjustments. But great thing is it's never going to go down. You're always going to be receiving at least that dollar amount you were receiving that first year that you retired from our system. And we will talk about the cost of living adjustments and how those are granted by the legislature towards the end of the program. The teacher's retirement system is governed by a 7-member unpaid board. And we have 2 offices, our main office here in Charlestown, and we have a small office in Springfield. And between the 2 offices, there's about 90 staff members now. Now, the MTRS is now the largest of the public retirement systems in Massachusetts. There are 104 public contributory retirement systems. There are city retirement systems, town retirement systems, county retirement systems. And now the Mass Teachers Retirement System with the active member population and our inactive members. There's, over 100,000 members with money on account, and a retiree and survivor population is really the population that's growing the fastest. We have over 70,000 retired members or survivors, people that are receiving benefits from the system. A total of 194,905 people. Now, throughout your career with the teacher's retirement system, when you join our system, we first establish your account here. We establish your annuity savings account. As I said, that's your own individual account with the teacher's retirement system. And when you contribute your monthly retirement contribution, that comes into us and we track that for you in your account. Throughout your career, we maintain that annuity savings account, typically send out annuity savings statements on a yearly basis. This year's was delayed because of a computer upgrade. We're hoping that we will be able to get those out to people. We process service purchases. If you have rendered any service that is purchasable, where you can add those years or months of service onto your own record with the retirement system, and we're going to focus on purchases for you today. And we also keep you informed of retirement issues that may impact you through seminars like this, broadcast emails, putting information on our website, which is a great resource for everybody. So we try to keep our membership informed as much as possible. If you do leave active service before you do retire from the system, you do have the option of taking a refund of your money from our system. So we would process any refunds for people. And if you do pass away, we process benefits to survivors. It is important for people to keep a beneficiary designated with our system because that tells us, should something happen to you, who would you like us to pay money to, and how should we pay that money out to those people or that person? And once somebody does retire from our system, we pay you your monthly retirement benefit, pay benefits to any survivors, depending on what option you may have selected and if there's any beneficiaries associated with your benefits, and keep you informed as to, any retirement related issues that are important to you. Our website, as I mentioned before, is a great resource, probably our best resource. It's where all information goes first. So it's a great website to check throughout the school year, mass.gov/MTRS. It's where all of the forms that you would use in throughout your career are located. Service purchase applications, that beneficiary designation form I mentioned is there on that website. The retirement application that everybody would need to use to retire, refund applications. We do have a benefit estimator that is there. Just on the main publicly facing website, we have a benefit estimator where you can play with that in a number of ways. You put in your own information, how many years of service you believe you would have at the time that you're retiring, what your salary average will be at the time you're retiring, and how old you would be at the time you're retiring. And it will do those estimates for you under the different options A, B, and C. So it's a great resource, great tool, especially if you're not sure, what happens if I buy these 2 years of service? What do those 2 years do for me? What happens if I leave next year and I don't work the next 3 years? So you can play with it in a number of ways. It's very helpful. As I mentioned, it's where we always put information first. So if there's any pending legislation that may impact our members, that goes right up on the website as soon as we can get it up there. We post all of our regulations and try to make that as useful as possible. I do recommend joining our email list. So if you don't know if you have ever sent us your email address or given us an email address to use, you can absolutely do that by sending an email to GenInfo and just asking to make sure that we have your email address on file. Whenever something happens that our membership needs to know about, we do send broadcast emails in most cases. Do we have any questions at this point? Excellent. Let's keep on going in the interest of time here. Now, everybody should have noticed by now that a certain percentage of your check is missing every time you receive it. It's kind of a funny way of saying it, but a lot of that money that comes out of your check is coming into the teacher's retirement system as your required contribution. This slide here goes through all of the different contribution rates that have kind of happened throughout history leading up to today. If somebody had started contributing to our system prior to January 1st of 1975, they paid into our system at a flat 5%. From 175 to 1278, they paid in at 7%. And then you'll see on the slide here where we have these 7+2, 8+2, and 9+2 contribution eras. What that additional 2% is is an additional 2% that somebody has to pay on any earnings over $30,000. So if somebody was a 7+2 member and they were earning $35,000, they would contribute 7% on that whole $35,000 and 2% more on just the $5,000, the amount over $30,000, and that would be their total required contribution. When Retirement Plus was enacted by the legislature, as of July 1st of 2001, anybody that elected into that Retirement Plus program elected to have their contributions go up to a flat 11%. So they're not paying 9% on everything they earn and 2% more on anything over $30,000. If somebody elected into Retirement Plus, they're paying a flat 11% on their total earnings. And any new teacher that started contributing to our system after July 1st of 2001, that 11% rate became the prevailing rate at that point. So anybody who elected into Retirement Plus, those are members that were paying into our system before July 1st of 2001. If they elected into Retirement Plus, they elected to have their contributions come in at a flat 11%. And then any new employee who started paying into the teacher's retirement system after July 1st of 2001, they also are mandatorily enrolled at that 11% rate. When Tier 2 was enacted by the legislature, the Tier 2 group of employees, anybody who started on or after July 2nd of 2000, rather April 2nd of 2012, excuse me, they also are paying in at 11%. But because those new members from April 2nd of 2012 forward are Tier 2 members, they're paying in with that new benefit structure, they are paying 11% to the retirement system. But also in that legislation, it says once those Tier 2 members have contributed for 30 years, at that point in their 30th year, their contribution rate goes down to 8%, and they would contribute 8% from that point forward. The reason why there's a finger with a string on this slide is to remind you to take a look at your next pay stub, make sure that you understand what you're contributing, what's being withheld, and if you do have any questions about your contribution rate, we suggest that you reach out to your employer, and if they have any questions about the rate that's being taken, they can speak directly to an employer service representative who handles their school district here in our employer services unit. Now, if you know a percentage you're supposed to be contributing, this slide here is a great tool, great resource for the types of salary that you should make retirement contributions on. And if somebody's a little bit closer to retiring, another way to look at this slide is everything on the left-hand side is included in your salary average. They should withhold retirement contributions on those types of salary because that is salary that you can use towards your salary average for retirement purposes. Everything on the right-hand side of the slide would be excluded and not usable towards somebody's salary average for retirement. Therefore, they should not withhold retirement contributions on those types of salary. So I'll go through them for you. Your annual salary per your collective bargaining agreement, your base pay, is always pensionable. So usually towards the end of a contract, we see the salary schedule that shows a teacher with their master's receives $70,000, teacher with their master's plus 30 gets $80,000, whatever it is. So that tells us what your pay should be per the collective bargaining agreement. And when you retire from our system, we ask that you send in copies of those salary schedules so we can make sure that your base pay matches up with what you're actually receiving as payment from your district. If somebody has an individual contract, your individual contract sets forth for us what your base pay is, and it would tell us in that contract what you should be receiving for pay for that school year. Base pay, always pensionable. Regular longevity. If there's a longevity clause in your contract that says once you've been here for 10 or more years, you receive $1,000. Maybe once somebody has been in this district for 15 or more years, you get $1,500. Once somebody's been here 20 or more years, you get $2,000, whatever it is. Those payments are regular and recurring. They're listed right in the collective bargaining agreement. It's available to anybody that meets those thresholds. That's what we mean by regular longevity payments. Athletic coaching is one of the few types of regular compensation that's listed right in Chapter 32 of the Mass General Laws. And it's one of the few things, because it's listed in the law, that it can be paid by the day, the minute, the hour, by the season. It really doesn't matter as long as it's related to the instruction of athletics. So athletic coaching, those stipends would be usable. Annual payments for additional services pursuant to the collective bargaining agreement. It's kind of a long way of saying, the additional duties, things that additional services you're rendering that are part of the contract. And usually there's a few pages in the contract that tell us what those are. We would need to see the duty and the dollar amount that you should receive for rendering that service. As long as it's in there, it's in the collective bargaining agreement, that would be considered regular compensation and usable towards your salary average. There's usually a few pages that list the coaching stipends. There's usually a few pages that list the additional duties or other stipends. Yearbook advisor, $1,200, mentor, $1,000, whatever it is. We want to see the duty and the dollar amount listed in that contract or collective bargaining agreement in order for it to be usable as regular comp. Things that we know are definitely excluded would be any amount paid due to your employer's knowledge of retirement. If you have told them that you're retiring and then you receive some type of an increase in pay, that would not be usable as regular compensation, looked at as a retirement incentive. Sick leave buyback programs, it's fine to get paid out for any of your unused vacation time, would not be considered pensionable earnings, simply between you and the school district, the city or town. Unused vacation time, same thing. If somebody's paid out at the end of their career for any unused vacation time, not usable towards your salary average, they should not withhold retirement on that. Hourly payments are typically out. The two types of hourly payments that would be considered regular compensation would be athletic coaching and school lunch or breakfast duty. You have to be physically in the space where the children are eating their lunch or breakfast. If you're covering that and they're paying you by the hour, that is considered regular compensation. And that's because of a court case where that was being required. So that is considered regular compensation. A temporary salary augmentation is a long way of saying a one-time payment. If they pay you once for something, if it does not become part of your base pay from that point forward, it's a good way of figuring out if something is a temporary augmentation. That's not considered regular comp. And then annuities and fringe benefits have been phased out many years ago, and nobody can use any of those annuities and fringe benefits if they do have those in their individual contract. Do you have any questions at this point to go? All right, we're going to keep on going. I'm hearing that our team is doing a great job answering a lot of the questions. We're trying to stay on top of it. So there's none here for me, so I am going to keep going. In this next section, we're going to be covering these topics. Your MTRS annuity savings account. As I said, that's the account here where all of your contributions come in. If somebody pays money for a service purchase, that money goes into your own annuity savings account here. And if somebody did leave service before they wish to take a pension from our system or before they're eligible for a pension, they'd be eligible for a refund of that account. And we'll talk about those refund scenarios and how that works. We're going to talk about retirement benefits, regular retirement. If somebody's retiring at the end of your career, we refer to that as a superannuation retirement benefit. There are disability benefits available to our members, both ordinary and accidental. And I'll talk about those two different types of disability benefits, and termination retirement benefits available to our Tier 1 members only. In-service death benefits are also important to understand and know about. If you are to pass away while you are an active teacher in our system, we'll explain to you how that would work in terms of family members or survivors and what they would be eligible for from the retirement system. Now, if somebody stops teaching, in order to get a refund of your money from the teacher's retirement system, you have to have completely severed from service. If you resign voluntarily and you have less than 10 years of service, you would receive interest at the rate of 3% on your total accumulated deductions, and that's compounded annually. If somebody has 10 or more years of creditable service, you would receive interest at the regular rate. And the reason why those are different is because once somebody has 10 or more years of service, technically you're vested in the system. If somebody's a tier 1 member, let's say they're 45 years old, they have 11 years of service, they can leave their money on account and wait until they turn at least 55. You have to be a minimum of 55 in order to effectuate your benefits, but you could leave that money on account at 45, and then at 55, figure out what your pension's going to be based upon your age factor for 55 and having 11 years of service. So you can do that. You can leave your money on account and wait until your age factor increases all the way up to age 65 if you're a tier 1 member. That's where the age factors stop increasing at 65. If somebody is involuntarily terminated, you would receive interest at the regular rate. And in all cases, you may receive interest for only 2 years after your separation from service. So once you have gone inactive, you have 2 years where you would receive interest on your money. And then beyond that point, if you took a refund, let's say after 5 years of inactivity, you'd receive interest for 2 years and you'd be foregoing 3 years of interest. So it is, important for you to make up your mind, kind of figure things out, hopefully within the 2-year period, so that you don't lose any interest or any money at that point. Now, if somebody is taking a refund of money from our system, we want you all to be aware of what that means. If you do take a refund of your money from our system and you were a tier 1 member, once you take a refund, you're not only refunding all of your money from the retirement system, you're also refunding your rights that you had based upon when you became a member of the system. So if somebody takes a refund of their money under and they were a tier 1 member, if they came back tomorrow, they would be enrolled as a tier 2 member, and the benefits are a little bit different in terms of the structure, and it would take them longer and they'd have to be older to get the same benefits afforded to them under tier 1. So under tier 2, there's those new age factors that I was mentioning at the beginning that would require you to work longer. The salary average period goes from the 3-year salary average to a 5-year salary average, and you have to be a minimum of age 60 to retire under tier 2. So it does have a significant impact on what those persons' benefits would be if they're going from tier 1 and then coming back into membership later under tier 2. They would also have to repay the money that they refunded plus interest in order to get credit for those years of service that they refunded originally. Now, to switch gears here and talk about retirement scenarios and retiring from the teacher's retirement system, we have just main eligibility criteria. This is for anybody. You can be any age as long as you have at least 20 or more years of creditable service. So under tier 1, you don't have to meet an age threshold. You could retire at any age as long as you have 20 or more years of service, or be 55 or older with a minimum of 10 years of service. If somebody is in the Retirement Plus program, there's some additional criteria they would need to meet to qualify for that enhanced benefit under Retirement Plus. You can be any age as long as you have at least 30 years of creditable service, and 20 of those years of creditable service have to be what we consider membership service where you are making direct contributions to the Mass Teachers Retirement System. So as long as you have the 20 years of direct membership service where you're working as a teacher in Massachusetts and contributing to the Mass Teachers Retirement System, the other 10 or more years of service to get you up to 30 or over 30 years can come from any combination of service purchases, transfers in from other retirement systems in Massachusetts, but you have to meet those 2 criteria. You have to have 20 years directly paid into the teacher's retirement system and 30 or more years of service for that enhancement to kick in for you. The enhancement under Retirement Plus works in such a way where once you have 30 years of service, you'll receive 12% more than what your benefit would be under the regular formula. And it increases 2% more with each full year of service you have beyond 30 years. So at 30 years, you would receive an increase of 12%. At 31 years, you'd receive an increase of 14%. 32, 16, 33, 18, 34, 20. It keeps on going until somebody does reach that 80% maximum benefit. Now, I mentioned there were two types of disability retirement benefits available. An ordinary disability is if somebody, had a pre-existing condition, maybe something that's preventing them from being able to continue working in their position. They may qualify for an ordinary disability benefit. The service requirement is that you have to have at least 10 or more years of service to qualify for the ordinary disability. And the formula works in such a way where we would use the regular superannuation formula. And if somebody is younger than age 55, we increase their age factor used in their calculation to the age factor of 55. So the ordinary disability formula doesn't really help people if they're older than 55 at the time they're trying to retire under an ordinary disability. And if somebody's in Retirement Plus and they have 30 or more years of service, their retirement benefit under Retirement Plus would probably be better than what that ordinary formula would do for them. If somebody is a military veteran, they would be eligible for 50% of their last annual salary, plus there's an annuity portion added into that. So if somebody is in a tough situation, maybe you have something that's preventing you from being able to continue working, I do recommend you contact us and we can help to go through that formula with you. An accidental disability benefit is where somebody is hurt on the job while performing their job duties. There's no service or age requirement. Somebody could be hurt on their first year of working and qualify for an accidental disability. It has to be due to an injury or hazard sustained while performing their job duties. And the benefit formula there works in such a way where they'd be eligible for 72% of their last annual salary, plus there's an annuity portion added in. It usually doesn't go above about 75% of their last annual salary in terms of what their benefit would be. But again, that's if somebody is hurt on the job, they can no longer work because of that injury. Now, termination retirement benefits are only available to Tier 1. When they created Tier 2 in our system, Tier 2 does not contain the termination retirement benefit, but Tier 1 members would be eligible for a termination benefit as long as they had at least 20 years of service. The termination has to be completely involuntary, usually for a reduction in force or a failure of reappointment. Maybe if somebody was a HVAC vocational instructor and the school where they work is doing away with the HVAC program, they may qualify for an involuntary termination benefit. It cannot be due to any moral turpitude, so cannot be fired for cause and then qualify for a termination retirement formula. And the formula works in such a way where we would look at your 3-year salary average. They'd be eligible for 1/3 of that salary average plus an annuity portion added in. Now, this is another benefit where we'd have to look at how old the person was when they're retiring from the system. Typically, if somebody's 55 or younger, the termination formula may help them to get a better benefit. If somebody's already 55 or older and they have 20 or more years of service, we would have to look to see if the termination formula would be a better calculation for them. And we can do that with somebody. I think we do have some questions here, so give me 1 second and I will get the question and answer it.
Hi, Scott. The question is from Michelle. It says, I regularly work extended school year and my district pays hourly for this. Can this be used towards retirement?
So typically work extended school year and wants to know if they can use that additional salary towards retirement. So if it's in the contract and you are required to do that position and paid hourly for that work, it would be considered regular compensation. We do need to see how it's constructed in the contract, that it is in there, that it is required of all of the teachers at that school is usually how it's laid out. And if that is the case, yes, that would be considered usable towards your salary average.
Got one more from Don. Is 80% the most that a retiree can collect?
Excellent question, Don. So in Massachusetts, the maximum percentage that somebody can receive is 80%. So that is the maximum. And that is across the board. That's not just the Mass Teachers Retirement System. That's any of the publicly controlled retirement systems in Massachusetts. 80% is the max. 80% of whatever your salary average calculation comes out to be. Good. Excellent. Two good questions. Now in this section, we're going to talk about your creditable service and how you accrue creditable service by working, and then we'll get into those service purchase opportunities as I mentioned before. Typically when somebody's teaching as a teacher in a school year, September to June, you have a 10-month contract, you work all 10 months full-time, you get credit for 1 year of service. Now, it's pretty easy to conceptualize that. Every month of service that somebody works, you get credit for 0.1. Once somebody has worked that full school year, you've worked all the required work days in your contract, you're going to get credit for a full year of service. Now that can be different district to district. You might have to work 183 days. The next town over might have 185 days in their contract, 182 days in their contract, whatever it is. What we do to be technical is we take the total number of days that you worked in that year and were paid for, and we divide that into the total required work days. So if somebody worked, let's say 40 days, we're going to take 40 divided by 183, if that's the total number of days in their work year, to figure out how much credit to give them for that portion of the year that they worked. Full years and full months of service are always used in your calculation. So there's common misconceptions out there. You only get credit for full years of service. You need to work at least a half a year to have that half a year count. To be technical, you get credit for every month that you have worked. We typically refer to administrators as 12-month employees. The same premise works for administrators. They need to work all of the required work days in their contract to get credit for a full year. So an administrator's contract might be anything from 190 days to 260 days. If it specifies you need to work all 260 days, and that's your work year, then we need to see that you were paid for those 260 days in order to give you credit for a full year of service. Leaves of absence are very important to have documented. If somebody's out on a paid leave of absence, typically those are referred to as sabbaticals. We can give you the amount of credit for what you were paid. So if somebody was out for a full school year, receiving 50% of their salary over the course of the whole school year, they would get credit for 50% of the year, 0.5. If somebody was paid for 4 months and they're paid full for 4 months on a paid leave, they'd get credit for the 0.4. Unpaid leaves of absence are also very important to have documented. The law allows us to give you credit for up to 1 month of service for any authorized leave of absence. So we just need some documentation from the school district. Mr. Smith was on an authorized leave of absence, from May to June of this school year, and the law allows us to give you 1 month of service credit. So as long as somebody is out for 1 month or more, we can give you credit for up to 1 month of service for being placed on an unpaid leave of absence. Every month helps you to get a better benefit from our system, so it's important to have those leaves of absence documented. Now, part-time service can get a little tricky. So first, I always like to start with the criteria to be a member of the teacher's retirement system. In order to contribute to our system, in order to start contributing, you have to be working under contract in a position half-time or greater, so 50% or more under contract with the district, in a position that requires you to be certified by the Department of Ed, and you have to hold that certification. So if somebody was working in our system prior to November 9th of 1990, and they were working 50% or more, so half-time or greater, prior to November 9th of 1990, we can give them full-time service credit for their work. So any part-time service 50% or more prior to November 9th of 1990 will be given FTE, full-time equivalency. If somebody they started working half-time before 11/9/90 and they continued working part-time, they never worked full-time, all the way up to July 9th of 2010, because they never had a status change to full-time in that time period, we would be able to give them full-time equivalency for all of those years of service. So between 11/9/90, somebody started working part-time, they never had a status change to full-time until July 9th of 2010, we would give them full-time service credit for all of those years of service. As of July 9th of 2010, a new regulation went into effect that says that anybody working part-time from really that 10-11 school year forward is going to receive the prorated service credit. So nobody is receiving full-time equivalencies after July 9th of 2010. And anybody that was still working part-time all the way up to July 9th of 2010, from that 10-11 school year forward, we're starting to prorate their service credit. Now, some people started working part-time prior to 11/9/90. Let's say, you were working 50%, and then in 1995, you started working full-time. Because you had that status change to full-time, we're going to give you your part-time service credit up through 11/9/90, and you're going to receive that prorated service credit from that point forward, from when you went that full-time. There's additional information on part-time service scenarios on page 34 of the booklet. There's some really good information there as well to help if you are working part-time. It goes through how your salary average would be calculated for retirement purposes. If we are giving you part-time service credit, it explains how we would annualize your salary for the salary average calculation. So that's a really helpful information, really helpful for anybody that's working part-time leading up to retiring from our system. Now, I've mentioned a few times that there are different types of purchases that you can make with our system to add service credit to your record. Now, these are the most common types of service purchases here. All of the ones at the top section of this slide are currently billed at a 7% compounding interest rate. And the ones at the bottom of this slide are under a different section of the law. Those are currently calculated with a 3.5% compounded interest rate. A refund buyback is if you ever took a refund of your money from the Mass Teachers Retirement System or any of the other publicly controlled retirement systems in Massachusetts. So if you used to pay into the City of Lawrence retirement system and you took a refund of that money before you became a teacher, you could purchase that refunded service back with the Mass Teachers Retirement System. We would need the City of Lawrence retirement system to tell us how much money you refunded from their system, and they would also need to tell us how much service credit we could give you for that time period. If you took the refund from the Mass Teachers Retirement System, we have all of that information and we can do those calculations for you. On our website, there are service purchase applications for all of these different types of purchases. So if you go into the forms section for active members, you'll see different service purchase applications for these types of purchases. There is one for refund buybacks on there now. So it's helpful to take a look at the service purchase application. Most of them have eligibility quizzes that would help you to determine whether or not you are eligible to buy the time. So it's very helpful to take a look at those and go through the steps you would need to take and the information you need to have your former employers fill out on those forms. A Mass, state, or municipal employment purchase, we commonly refer to that as other Massachusetts government service. You are being paid with public funds in the state of Massachusetts, being paid directly by a city, town, or the state of Massachusetts. There's a very good chance that you'd be eligible to purchase that time. So you would use the other Massachusetts government service purchase form. Massachusetts substitute or temporary teaching, obviously as the teacher's retirement system, that's a fairly common one that we see. If you were ever a substitute teacher before you started working in your full-time position as a teacher, if you were ever working less than 50%, you would not have been eligible to pay into the teacher's retirement system directly, but once you establish yourself as a member in our system, you would be eligible to purchase that time back. And you would use that substitute or temporary teaching service purchase form to do that. It's actually sort of our all-purpose form that we use for any work somebody did in a school. I think it's, used to be referred to as the teaching paraprofessional, substitute teaching paraprofessional tutoring, kind of catch-all for work somebody was doing in the schools. Out-of-state public school teaching is purchasable, provided you are working in a public school and that you are not eligible for a retirement benefit from that other state. So we do have a section on that purchase. Section 1 you fill out. Section 2 is filled out by the school district where you worked. And then Section 3 goes to the retirement system that you paid into while you were working in that other state as a teacher. You're eligible to purchase up to 10 years of out-of-state public school teaching service with the Mass Teachers Retirement System. Non-public school teaching rendered prior to 1973. That's the only purchase that allows for people to purchase service where they're paid with private funds. If somebody was working at a parochial school, working for a private school, that service would only be purchasable if they rendered it before 1973. So we don't see too many of those service purchases anymore. And there is a Social Security component to that purchase, where if somebody did pay into Social Security while they were employed at that school and they are eligible for a Social Security benefit due in part to their work at that school, we could not allow them to get credit for that service in our system. A Department of Defense overseas dependent school purchase is only available to somebody who worked at a Department of Defense school, and that school has to be in another country. So usually those schools are on Army bases or Air Force bases, and we would need the Department of Defense documentation on that service in order for you to be able to purchase that. Now the purchases at the bottom here, as I mentioned, are billed at a lower interest rate. They're covered under a different section of the law. Military service, people are eligible to purchase up to 4 years of their military service. You have to meet the definition of a military veteran pursuant to the Massachusetts general laws. So it's not the same as the federal determination of a military veteran. You'd be eligible to purchase, as I said, up to 4 years of your military service. Non-public school teaching in a Massachusetts publicly funded school. Usually these purchases are for a special needs student population where a school district is not able to provide the educational needs that that student needs, and they pay for that student to go to a school of some sort. If that school where you were working only had Massachusetts children and you could prove that you were only teaching students from Massachusetts and there was no privately paid students, no students from other states, you would be eligible hopefully to purchase that type of service. We do need to know if there was any type of a retirement plan for you and if you are eligible for a retirement plan based on that service at that school before we could allow you to purchase that with the teacher's retirement system. The vocational service purchase is where vocational educators are able to purchase up to 3 years of the trade experience that they had to have in order to get their vocational certificate. You have to have been a teacher in a trade service. You have to have been Chapter 71, I believe, Chapter 71 certified in order to purchase that service. And then the Peace Corps service purchase is also up to a maximum of 3 years. It's for any work that somebody did in the Peace Corps prior to them becoming members of our system. Now, if you do believe you are eligible to purchase some of that service, as I mentioned, go to our website, go to the forms section for active and inactive members and download that service purchase. Go through that eligibility quiz, take a read through the application to see what you need to do. You're going to fill out your section, send that form to the employer, whoever it was that was paying you, so that they can document how long you worked there, number of days, number of hours, how much you earned, what the daily or hourly rate was, how much you earned total in that position. We need all of that information so that we can construct a cost for you and figure out how much service credit you would be eligible to purchase. Now, the cost on these purchases typically includes the principal amount. That's based on what you actually earned in the position. And what we're figuring out is how much you would have contributed to the teacher's retirement system if you had been a member of our system at that time, earning that salary you actually earned in the position. The law specifies we need to know what you actually earned while you were working in that position so we can do those calculations. Special formulas do apply to the vocational purchase and the military purchase. Those are based on your first year's teaching salary or first year's salary when you first became a member of a public retirement system in Massachusetts. If we do send you an invoice for your service, we're going to tell you on that invoice exactly how much service you're eligible to purchase and how much it's going to cost you to get credit in our system for that service. You can pay for service using a personal check out of your checkbook, where you write us a check right out of your checkbook, send it in to us. We're going to code that in our system as after-tax money, came out of your checkbook right to us. Or it is now possible for you to use pre-tax money to pay for a service purchase. You can use money that you have in a 403B or an IRA to pay for purchases of service with a defined benefit plan. That is something that you can do so that you don't have to dip into your savings account. Money comes right out of your 403B or your IRA into our system as a pre-tax rollover. So it's one of the only ways that people can access money in those pre-tax savings plans without any tax implications. You can purchase service in a defined benefit plan by sending that, doing that rollover or trust-to-trust transfer pre-tax. It's a really nice way of doing that if you do have the money in one of those types of funds. Main rule on purchases is that in order for us to include it in your service calculation for retirement, you have to have paid for that service purchase before your date of retirement. So we oftentimes have people trying to purchase service, right before they retire, and you want to make sure that you have paid it in full, or that your IRA company, the 403B company, has made that transfer to us or rolled that money over to us before your date of retirement, so that we can do that and it doesn't impact your retirement date with our system. It's now very important to understand that you have to be an active contributing member of our system at the time that you apply to buy service purchases. Now, that changed due to a court case about 5 or so years ago. You do now have to be active at the time that you make application. So if you applied while active and then you stopped working, we would still honor that application for you. But at the time that you apply, you have to be an active contributing member of our system. An exception to that rule would be the Peace Corps service purchase and a refund buyback if you did have one of those. All service purchases, as I said before, have to be paid for in full before your date of retirement, and you don't want to get stuck in that rut where a late payment could postpone your date of retirement and possibly delay your first retirement check. Now, in this next section, I'm going to turn it over to Chris, but before I do that, I'll take a couple questions because I know we have some good ones for everybody.
Great. Next question is, what about going full-time to part-time during the 1990 to 2010 period and then back to full-time? Would those be partial years of full-time?
So if somebody went part-time, what really drives this is whether or not they ever had a status change to full-time. So if somebody was part-time all the way up through 11/9/90, and let's say they went full-time in the 1992 school year. Once they went full-time in 1992, that means they had a status change to full-time. All of their service from 11/10/90 forward is going to be prorated. They would get full-time equivalency up to 11/9/90 and then prorated service from 11/10/90 forward. If they were working 60%, they're going to get the 60% credit. If they were working full-time, they're going to get the full-time credit for that year. If they then went to 70%, they're going to get the 70% credit for that year. So really what drives whether or not they're going to have that change to having their service prorated is if they had a status change to full-time anytime after 11/9/90. If somebody maintained their part-time status, they never had a status change to full-time, until after July 9th of 2010, that's the only situation where they would be receiving full-time equivalency for all of those years of service, because they never had a status change to full-time. It's the status change to full-time that drives how we have to do that proration of service. I hope that helped. That was a tough one.
Okay, next question. Hopefully not as tough. Can I buy back years I was a paraprofessional before I became a teacher? Would that go towards my retirement as a math teacher?
The answer on that is absolutely. If you were a paraprofessional in Massachusetts, working in the Massachusetts schools, and you did that before you became a member of the Mass Teachers Retirement System, I would recommend that you check with the local retirement system where you were most likely contributing as a paraprofessional. See if you ever took a refund of that money. If you did, you just need to let us know about that, and we will ask that other retirement system for a refund breakdown. They will tell us how much service we could give you and how much money you refunded from that system. The reason I'm saying to check with that local retirement system is because if you didn't take a refund of that money, you may still have money on account with that system. If we don't know about that yet, you could let us know. I still have money on account with that local retirement system, and we would request a transfer of your funds. By law, they have to send us the money that is on account with them, and with that transfer of funds comes the transfer of service. They would tell us how much service to associate with that transfer, so you wouldn't have to purchase it in that situation. The money would transfer right into our system, and we would give you credit for however much service they told us that we could give you.
Can you buy sub-teaching and vocational education separately, or is it capped at 3 years total?
So can you purchase substitute service and then your vocational work separately? And the answer on that is yes. We would look at that as two separate purchases. Your vocational work experience that you're purchasing is really the trade service that you had to have before you could qualify for your vocational certificate. So that's the service that you had to have documented and sent in to the Department of Ed so they could look at that and make sure that you met the criteria for them to certify you as a vocational educator. That's technically the work that you're purchasing, your trade experience. So that would be one purchase, and you're eligible for a maximum of 3 years of service for that purchase. And then the substitute service we would look at differently, and we would calculate that completely separately. However many days you worked as a sub, we would total up the total number of days as a substitute teacher, divide that by 180 to figure out how much credit to give you, and see how much money you earned as a substitute teacher and use that in the calculation to determine the cost. So those would be looked at as two separate purchases, and neither one of them would be, you wouldn't be held to only 3 years total. You could buy up to 3 years of service for your voc time, and you could purchase whatever your sub time came out to be. Excellent. Thank you again very much for attending our program today. I'm going to turn the program over to Chris, and he'll take you through the rest. Appreciate it.
Hello, thank you for joining us today, and I want to start by thanking you all for your service to the Commonwealth as educators, and want to wish you a happy beginning of the 2022-23 school year. Hopefully everything is going well at your school, in your classes, and if you're an administrator managing the building. So what I want to start out with here is, before we jump into the 3 benefit options, is really explaining what drives survivor benefits, from the retirement system. When you retire, you're going to choose one of the options you're seeing on your screen, A, B, or C. A, B, or C, this selection will drive your survivor benefits when you are retired. A little later in the program, we are going to talk about in-service death benefits. What would happen if you were to pass away as an inactive or active member of our retirement system? An active member is somebody that's actively contributing through payroll contributions, and an inactive member is somebody that's left service but has funds on account. There's a big difference here, because once you retire, your survivor benefits would be driven by your option selection. So before we get into the options, I just want to remind everyone that you can check on your member self-service account online. It's called a MTRS account, who your active or inactive beneficiary is. But if you're unsure, you can go to our website, download the active and active beneficiary designation form and submit it in the newest form. Will keep your beneficiary current or up to date. So if you're not sure who your beneficiary is, feel free to send us. You could call us. We can't answer it in an email. You could call us. We could update you with who your beneficiary is, or access your member self-service account to figure out who your beneficiary is, or send us a new form. So again, we'll talk about what happens if you were to pass as an active or inactive member a little later in the program. The three options you're going to choose on the retirement application. If you were to go to the form section of our website, you would actually, on one of the pages, select A, B, or C. Option A is your maximum allowance. It doesn't mean you automatically receive 80%, but based on your years of service, your salary average at retirement, and your age, we use an age factor as of and we use it at the date of retirement, what your current age is. We use an age factor, and we'll figure out what your percentage of your salary average is. That's your max allowance. We'll go over the formula actually in the next couple slides here. So under option A, your maximum allowance, you'll receive that based on your years of service, age, and salary. However, in retirement, if you were to pass away, there would be no survivor benefits, only what would be due to somebody in the month of death. If you don't know, as a retiree, we pay you once a month on the last business day of the month, and that payment would be for that month. So we're paying tomorrow, September 30th, for the month of September, all of our retirees. So you would name a month of death benefit recipient, but it would only be for the amount of time period that you were living in that month if you were to pass. So option A, some members say, well, why would I choose A? Well, you might have life insurance or some other financial vehicles that would leave a benefit to a survivor, or you don't have many years of service. You have the bare minimum 10 years to be vested. So you just want to choose A because one, you need the money because this benefit is because you don't, isn't that high because you don't have that many years of service. So you need the maximum allowance, or again, you have some other financial vehicles not separated or not connected to the MTRS where you could get a survivor benefit for a spouse or loved one. So option A actually is our highest selected option. It's around 60 to 67% each year of our retirees choose option A. And again, probably because they have some other financial vehicle to leave a benefit to a spouse, or because they have less years of service, don't have that max 80% benefit and need the max allowance. I do want to point out that you got a registration email before the event, and that contains a booklet that contains all the slides. But in addition to the slides, it contains a lot of helpful information in the footnotes. So don't leave the presentation now, but after the presentation, if you want to reference any of the materials that we're discussing, get more information, please pull up that link, or it's on the homepage of our website. Halfway down the middle of our homepage, you'll see our member publications, which includes this presentation or another presentation if you're close to retirement called Ready for Retirement. So to recap, option A is your max allowance based on your benefit calculation, but in retirement, no benefits to a survivor. In a morbid situation, you pass away from your date of retirement, there's no benefits to a survivor. The benefits stop and they cease from the Commonwealth. Now, if you're worried about not recouping what you've paid in over your active career into your annuity balance, then you might want to look into option B. Option B, as a member, you would receive 1 to 3% less than option A. So you're taking a small reduction each year for the rest of your life. And all of these benefits are lifetime guaranteed benefits, which is great. From your date of retirement, the benefit will never go down, and it's payable until death. Under option B, you will receive for the rest of your life 1 to 3% less than option A. So you're taking a small reduction. Now, 1 to 3% is a range, so I'll explain that the more money you have in your annuity account at the time of retirement, and generally the older you are, you'll be closer to the 3% rather than 1%. So it is based on annuity factors and based on how old you are and how much is built up into your annuity account over your career. So it will be between around 1 to 3% reduction from A. That's what the member will take home for the rest of their life. Now, if you were to pass in retirement, your beneficiary would receive a one-time lump sum payment of the balance, if any, remaining in the retiree's account. Now, the only time your annuity account will be factored into a benefit or survivor benefit in retirement is under option B. Think of your annuity account as a way to help fund your lifetime benefit. This is a public pension plan. It's a great benefit, but the annuity account turns into what's called an annuity reserve fund, and it's only tracked for the member's survivor benefit under option B. So in this case, if you retired with $100,000 and you chose option B, the member will take home 1 to 3% based on our benefit calculation, but slowly over time, what's in that annuity account will be depleted, because what will happen is once you start receiving your benefit under option B, the state is taking some of the money from your annuity account to help fund your benefit. About 20% of each paycheck you get in retirement under option B is reducing your annuity account. Option B, a weird way of describing option B, but one that might help you understand the benefit, is there will only be a benefit payable to a survivor if you were to pass away close to your date of retirement. If you live 10 to 12 years into retirement, at that point in time, your annuity account behind the scenes has depleted. So there's no further benefit payable to a survivor. So if you name somebody under option B, what the survivor would need to know if you were to pass is there would only result in a lump sum payment if you passed away within 10 to 12 years of your date of retirement. It's a way to safeguard your annuity account. You're worried about choosing option A because you get your max benefit, but you pass away close to your date of retirement. There would be a benefit, a lump sum benefit paid to a survivor. You can name anyone under option B as your survivor. It can be multiple individuals, it can be a family member, it can be a friend. There's no restrictions on who you can name as beneficiary or how you break it down percentage-wise. You can name 10 beneficiaries at 10%. But again, to recap, option B, the member is stuck with 1 to 3% less than option A for the rest of their life. It is a lifetime benefit. But if the member is going to live, and we all plan on living 10 to 12 years after your date of retirement, if you're in the audience, I would say, please say yes. In that case, if you live 10 to 12 years after your date of retirement, there'd be no benefit to a survivor, and you're stuck with that 1 to 3% reduction for the rest of your life. So again, way to safeguard your annuity account, and would result in a benefit only if you were to pass away close to your date of retirement. A true member survivor benefit, one that would probably leave a substantial benefit to a survivor, is option C. Option C results in a lifetime benefit for the member, but also if you were to pass, a lifetime benefit for one named individual that's closely related to you for the rest of their life. The caveat and what you need to understand about option C is you're going to take a bigger hit than obviously B, because we're leaving a lifetime benefit to a survivor. As the member, you're taking approximately a 9 to 11% reduction from option A. That is a huge generality. I'll explain. It's tied to your beneficiaries, named beneficiaries' closest age as of your date of retirement. So we look at their closest age and your closest age, and we have annuity factors that were established by the Commonwealth for all pension plans. If you name somebody close in age to you, such as a spouse, sibling, you'll fall within that 9 to 11% reduction. If you name somebody that's older, like a parent, the actuaries have figured out, well, they're older than you, likelihood of them surviving you is far less than a child. So if you name a parent, it might be less than 9%. But if you name a child in their 20s, 30s, you might be closer to a 15 to 20% reduction from A. So you as the member are going to take a greater hit to name somebody younger under option C. It generally falls within 9 to 11% if you name somebody close in age. So you're taking 9 to 11% less than option A. But if you were to pass, you would leave 2/3 of that amount as a lifetime benefit to a survivor. And there's no restrictions here. It would be payable to a survivor for the rest of their life. I'll start by saying you can only name somebody closely related to you. It can only be a parent, child, sibling, spouse, or former spouse who is not remarried. That's not a popular option, usually court ordered. I'll repeat, parent, child, sibling, spouse, or former spouse who is not remarried. Name one of those individuals as of the date of retirement, and then if you were to pass in retirement, that survivor would receive 2/3 of what you were receiving for the rest of their life. And you'll be offset based on an annuity factor, but again, close in age, around a 9 to 11% reduction for the member. One provision that you would need to be aware of if you chose option C, you can't rename another beneficiary if your beneficiary you named at the time of retirement predeceases you. We have option factors, and again, we figure out what your benefit will be based on who you're naming as of the date of retirement. So in retirement, you name your spouse. Unfortunately, they predecease you. There's something called the pup-up provision that would, in that unfortunate circumstance, at least allow you to pup back up to option A as of their date of death. You would not be able to rename another beneficiary. But in that, again, unfortunate circumstance, you would pop up to option A. If you have any questions about the options, please, we have a general info email that we'll share at the end of the presentation, but in your screen, you'll have a Q&A. You have two options there. You'll see the featured ones, which are the ones we're publishing to try to answer in the presentation. And then you'll have your questions or my questions that we have a team of experts behind the scenes taking care of. So please feel free to ask any questions. Let's get into the benefit calculation. The retirement formula is, if you're a math person, which I am, and I love it, and my wife's a math teacher up in Beverly, I would say that it is better to understand the formula than use our Retirement Plus charts. We have an estimator on our website, right on the homepage of our website, that is fabulous. We have a different estimator inside your member self-service account. We're doing this simple formula to show you how we calculate your benefits. And I'll explain that the Retirement Plus chart is helpful, extremely useful. It only works in full years. We use full years and full months in the calculation of your benefits. So if you work halfway through the year, you're a 10-month educator, you work 4 months, we can use 0.4 or 4 divided by 10 in your calculation. So you have an age factor that's associated with your age. Pretty simple for Tier 1 members. Again, the extended booklet that we have will have the age factors for Tier 1 and Tier 2 members, easier to remember for Tier 1. It maxes out at age 65. We multiply that age factor, which is based on your age as of your date of retirement, multiplied by your full years and months of credible service. If you're not in Retirement Plus, that'll give us the base percentage of your salary average to calculate your defined benefit formula. This is a defined benefit based on this formula. That base percentage would be multiplied by your salary average if you're not in Retirement Plus. If you're in Retirement Plus, we'll add on that Retirement Plus percentage that Scott explained earlier. For Tier 1 members, it's an additional 12% for reaching 30 years, and every full year after is an additional 2%. So if you have 31 years, it's 14%, 32, 16. If you're in Retirement Plus, that would be your total percent of your salary average. We take that percentage, multiply it by your highest 3 consecutive years of salary or your last 3 years, whichever is higher. Saw that question in the chat earlier. So as Tier 1, we use the 3-year average, Tier 2 is 5 years. So whether it's 3 or 5 years, we can always use the last 3 or 5 years of employment. So if there's breaks, that's fine, or your highest 3 or 5 consecutive. So if you're using years in your salary average that are not your last years of service, they just have to be consecutive, no breaks. We multiply that to, by the salary average to get your option A annual benefit. We're always calculating option A first, as you saw in the previous slide. The reductions for choosing B and C were clearly stated on the previous slide. If you are a veteran, you do get an automatic benefit. So if you're a veteran, you should look into possibly buying back your active duty military service. But in addition, there's an automatic benefit that's added to this formula, and it's $15 per year up to 20 years of service. It's $300 annually added onto your calculation. And if you're a veteran with the veterans benefit plus your option A amount, that would then be your option A total annual allowance. We're going to show you some examples for the formula to show you how this would work. And the examples are great to visualize this exact formula. Again, we do have the Retirement Plus percentage charts on our website. If that's easier to look at, if you have all full years, please do, or use one of our 2 estimators. Mary Educator retired last school year, and she was not in Retirement Plus, so she's not a non-participating. You can see the age factor is 0.019 at age 59. For age 60, it's 0.02, 61, 0.021, and it goes up 0.001 for Tier 1 members, maxing out at the age factor for 65, which would be 0.025. Mary's credible service is a mix of buybacks and regular contributing service. She was out in Pittsfield for 30 years, 30 straight years out in Pittsfield, bought back out-of-state service with Kentucky, some substitute service with Springfield, and other Mass. That in total equals 35.0 years. You can see we add up the full years and full months. In this case, it just happens to come out to a nice clean 35.0 years. We're going to have 2 different examples, one for a regular retirement and one for a Retirement Plus retirement. And the bottom figures here remain constant in both examples. We have a salary average calculation of $75,000, and Mary Educator is a veteran. If you look at the salary average, this would be her last 3 contractual years. So to help explain, we don't use calendar year, we don't use W-2s, we'll use your contract years. If you're a 180-day educator, usually those fall between 180 days and 190 days, depending on your contract. We use your contractual salary. Same for 11-month employees, 200, 220 days. Or if you're a 12-month administrator, we'd use your contract for the entire fiscal year. Whatever stated in your contract, not broken down by calendar years or W-2s, by your individual contracts or your collectively bargained contracts, whether that's Unit A or Unit B. So in this case, 1920 year, Mary Educator's total regular comp is 73,000. 2021 is 75,000, and 21-22 is 77,000. We simply add up the contractual regular compensation, what's eligible with stipends, divide by 3. In this case, comes out to a nice clean 75,000. Let's plug Mary Educator's figures into this nice formula here. And you can see it in real time here using the formula, and this is how we would calculate your benefits. This is what the retirement analyst will do at retirement. They'll take your age 59, the age factor multiplied by 35.0 years, equals 66.5%. Mary Educator is not in Retirement Plus, so this is not applicable. So her full percentage under option A, and this is again the option A calculation for a tier 1 member, is 66.5%, multiplied 0.665 or 66.5% multiplied by 75,000 is $49,875, plus 300 as a veteran's benefit, $50,175 a year. I already spilled the beans. You're paid once a month in retirement at the last business day of the month, so this is broken down monthly. Big pay cycle change as from an active member where you get paid maybe 26 times a year, 21 times depending on your pay structure. So you get paid once a month on the last business day of the month. And we'll talk about what will come out of your check a little later in the program as well. So $4,181 a month. I will say this, if you're a tier 2 member, don't worry, we have information available on our website, including a tier 2 estimator. If you look at the email that we sent you when you registered for the program, we have a link to this booklet, which contains additional information outside of these slides. And it is on page, I think 7, you'll see the R plus percentage. You'll see a side-by-side comparison of tier 1 versus tier 2 on page 25. And the retirement plus percentage charts for tier 1 and tier 2 are on page 27. So that will be something that you can look at on the actual presentation booklet that you can print from the registration email that we sent. Now, if Mary did choose option B, in this case, it comes out to about $468 a year less. So it's not a huge reduction. Now you can see the difference between A and B. In this case, Mary Educator is close to a 1% reduction. So what would happen is she's stuck with this 1% reduction for the rest of her life, but in about 9 to 11 years, remember, there's no benefit to a survivor because the amount in her annuity account has been exhausted. So again, if she chooses option B, it's really to safeguard what she's built up in her career in her annuity account. But if you pass away close to your date of retirement, that would leave possible lump sum benefit, if any, remaining in the annuity account to a survivor. But Mary, as the member, would receive a lifetime benefit for the rest of her life of $49,707 a year. Now let's see what Mary Educator would get under option C. What you're looking at here is an actuary chart that is, really defines the benefit under option C for all mass public retirees. I pay into the State Board of Retirement working here at the MTRS, police, fire pay into the local city county retirement plan. These factors are the same for all public retirees from the Commonwealth. We look at the beneficiary's closer age and the member's closer age as of the date of retirement. In this example, when we figure out the option C factor, we don't use the actual age. We use the closer age for both the member and beneficiary. Now, Mary's birthday, and you'll see this if you actually did download the benefit guide, is in November. So even though we retired and used her age factor when we calculated option A as 59, she's actually closer to her 60th birthday. So for option C, when we figure out these offsets, we go up to age 60 for the member's closer age. The beneficiary's closer age happens to be 59, and we can figure out the offset in this chart. So the option C factor is 90.99%, meaning Mary will take home 90.99% of option A, or if you want to state it differently, a 9.01% reduction from option A. That would be her benefit for the rest of her life. If you want to know what your option C factors would be, again, as a resource on our website, both of our estimators will provide you the opportunity to enter a beneficiary's closer age, and then figure out what your offsets would be based on the date of retirement you're selecting. So your closer age as of your date of retirement can be entered to figure out, hey, if I want to name a child, what's my offset? If I want to name a spouse or parent or sibling, what's my offset? So option C again has to be a parent, child, sibling, spouse, or former spouse who is not remarried. Let's again see this calculation done on this slide here by plugging in the numbers. Her option A annual benefit, Mary Educator, is $49,875 a year times the option C factor of 0.9099. We come out to an option C annual benefit of $45,381. Again, she's a veteran. Plus $300 brings us to $45,681 a year. Broken down monthly, Mary Educator's option C allowance would be $3,807 a month. If Mary were to pass away in retirement, her named beneficiary under option C would receive 2/3 of what she was receiving. So after the reduction for the age, 2/3 of what Mary was receiving, the survivor would receive that for the rest of their life. So you can see Mary's option C allowance, not her A, was $45,681. Multiplied by 2/3 would come out to a survivor allowance of $30,454 a year. Again, broken down monthly, the survivor would then receive $2,538 a month. And I just want to reiterate, lifetime benefit for the survivor in this case. So again, a strong benefit, a nice survivor benefit, something that is a benefit of being a public employee in Massachusetts. These pension plans always provide lifetime benefits regardless of fluctuations in the market. Let's move on to example 2, which is a retirement plus example, Tom Teacher. You'll see in these examples, Tom Teacher is participating in retirement plus. He's a little bit younger, he's 58 years old. He has a little less credible service with the same salary average and as a veteran, but his benefits will be higher because he's in retirement plus. He's a participating member. I do want to point out here that we have 34.5 years of service overall. As I mentioned earlier, full months factor into the calculation of your benefit at the time of retirement. So 34 full years, he's a teacher, so the 0.5 would represent 5 full months worked on a 10-month work year, if you wanted to boil it down to months. If he was an administrator, Tom administrator, the 0.5 would really be 6 months worked on a 12-month basis, because administrators' contracts are 12 months. So Tom Teacher has 34.5 years at age 58, and you see the age factor there is 0.018. Let's plug in Tom Teacher's example into our benefit formula. Under option A, the age factor would be 0.018. Multiplied by 34.5 years equals 62.1%. Now this is where the retirement plus percentage comes in. Once you reach 30 years as a participating member, and I just have to say you have to be participating at a flat 11%. If you check your pay stub and there's 2 MTRS contributions, that usually indicates you're not in retirement plus, even if you see the term plus on your paycheck. You might see something along the lines of 9% plus 2 or RET plus 2. That means you're a 9% plus 2% member. Only members paying a flat 11 participating in retirement plus will be receiving the enhanced benefit at the time of retirement. So 62.1% plus 20. How do we get to 20? 12% for reaching 30 years. Every full year past 30 is an additional 2%. So Tom Teacher has 30 years to get to 12%, plus the additional 4 past 30 is 4 years times 2%. So 8% plus the 12 for reaching 30 brings us to 20. Question came in the chat earlier. It caps at 80%. So in this case, even though his formula brings him past 80%, we cap it per state law at 80%. So Tom Teacher would receive 80% of his 3-year salary average. Again, tier 1 is a 3-year average, tier 2 is a 5-year salary average. 0.8 or 80% times $75,000 equals $60,000 annually plus $300 a year for being a veteran, brings us to an annual benefit of $60,300 a year. Monthly, $5,025 a month. So you've now seen 2 examples. One is a regular retirement. The second is retirement plus. To use our estimators online, you really need to know if you're participating in retirement plus or not, and whether you're tier 1 or tier 2, as Scott covered earlier in the program. Last thing we'll talk about before we switch gears here to being a retiree and what you need to know as a retiree of our system. So if you're nearing retirement, very helpful information coming up. But we unfortunately have to talk about in-service death benefits. And we've had examples here in stories of members calling, and it's such a sad situation. A member's terminally ill. And our advice to that member is it's better to go on leave of absence with your district. And if you are going to pass as an active member, instead of retiring and naming a benefit under option C or a spouse under option C. Again, I'll reiterate that the in-service death benefits for a member survivor are much greater than naming somebody as an option C retiree. You may not have that option. Of course, you might need the money, you might need the retire to collect. But if you're terminally ill, you can go on leave of absence with your district and try to use as much sick time through your district, apply for sick time if you're eligible, and then stay active or inactive because those benefits will be much greater for a spouse as the member survivor beneficiary. So if you pass away, it all depends. As an active member, your survivor, their benefit depends on what you name them as on the beneficiary form. And again, I explained earlier that you can download a new form on our website, send it in if you don't know who your beneficiary is, fill out the form again, or you can check on your member self-service account who your beneficiary currently is. So keep your beneficiary current. Something you don't plan for, unfortunately, right? It just unfortunately would happen. So if you named somebody as a lump sum beneficiary, and you can name multiple individuals at a percentage, as long as the percentage equals 100, they don't have to be closely related to you. You can name anyone as a lump sum beneficiary on our beneficiary form, active and inactive beneficiary form. If you were to pass away, they would simply receive a payout of your annuity savings account. Typically, a member survivor benefit will pay out more depending on how long your beneficiary will live. So one-time lump sum distribution if you name somebody as a lump sum beneficiary on the active and inactive beneficiary designation form. If you name somebody as a member survivor, which is the scenario which will leave a better lifetime benefit than naming them as option C, that member survivor, same as option C, can only be a parent, child, sibling, spouse, or former spouse who is not remarried. They would actually receive what you would have received under option C plus additional benefits for dependent children. So it's basically what you would have received under option C with no reduction. We still look at an age factor reduction, the closest age as of the date of death. If you're under 55, we increase that factor to 55, and we increase the closest age for the beneficiary the same amount of years and months. So to put it, as straightforward as possible here, and to clarify, if you name a member survivor beneficiary, your member survivor is going to get pretty much what you would have gotten under option C, and if you're under 55, even a higher benefit. Again, passing away as an active member will leave and instead of waiting and retiring under option C, will leave a higher benefit to your survivor. Now, additionally, if you have dependent children under the age of 18, the eldest child will get $120 a month, and every additional child will get $90 a month. That is payable up until age 18 or until age 22 if they're a full-time student. So please keep your beneficiary current. At this point, we can take any questions if we have them. Awesome.
Sure, Chris. We've got one. It's going back about 25 minutes or so. But the question is, if we haven't had a new contract for a number of years before retirement, and then a contract is negotiated with a retro pay, would the new salary be included in the benefit, and how would that work?
Thank you very much for that great question. On the retirement application, we ask if your current contract has been settled up for the year. If it has not been, we still ask you that you file a retirement application with the contract information available at that time. We will calculate your benefits. If your contract settles the next year, what would need to happen first is that your school committee, and we're talking mainly about collective bargaining agreements, individual contracts, it's rare that this would happen, right? So if collectively bargained agreements are not in place at your time of retirement for your current school year, or still being negotiated, in order to use the new rate in your salary average calculation, we first need the collectively bargained, the unit, the school committee, and the union to negotiate the salary schedule. The additional amount would need to be paid to you, and then you can then submit a new Part 2 with the updated information. Some districts are proactive and will reach out to us and say, hey, this person retired last June, it's now September, the contract's been settled, but it is up to the member ultimately to identify after retirement that that payment's been made. You first have to be paid that amount. retirement contributions or deductions would be submitted. And then we'll update the part two. You'll update the part two of the retirement application, send it in, and we'll adjust your benefits, and they will be adjusted retroactively back to your date of retirement. So there's no lost income in this situation. The benefit would be adjusted, and we can use that higher amount if a contract's negotiated after your date of retirement for the previous year. Just has to be paid first. And if you have any other questions, please throw them into the my questions, and we'll get back to you as soon as possible. But that's it for right now. Hopefully we're doing a good job keeping up with all of them. So as I mentioned, this last part of the program is referring to really your time here in the system as a retiree. What you need to know if you're approaching retirement. Health insurance, it's a common misconception that the MTRS will administer health insurance benefits and your health insurance coverage. You want to avoid any surprises because this insurance is offered to you from your local city or town. In very rare cases, if you're eligible, will you get it through the Group Insurance Commission directly, and there's about 43 or 45 districts that are in what's called the Retired Municipal Teachers Program. You can see in the first bullet point, when you are a year before your date of retirement, contact your insurance coordinator. If you're in the RMT and there's about 43 to 45 districts in the Retired Municipal Teachers Program, then you contact the Group Insurance Commission directly. Everyone else will reach out to their local insurance coordinator. That could be somebody in your school district, or because your city or town is covering police, fire, public employees outside of the school district, it could be somebody at town hall or city hall, like the treasurer. So if you're not in the RMT, contact your local insurance coordinator. You can start with your payroll department. If you're in the RMT, you would contact the Group Insurance Commission. Now, there are some unfortunate circumstances if we do have members of charter schools paying into the MTRS per special section of the law. If you work in a charter, you may not be eligible for insurance. If you went inactive at the end of your career, so you're now currently inactive in not contributing, that last district may not offer you health insurance. So check up for eligibility with the last district that you are retiring from or worked in. If you're currently active, been getting active insurance through your district, you should be eligible for some form of retiree health insurance. What you need to know, though, is are the plans, the premiums, and the providers all going to be the same in retirement? They could shift. There could be a different percentage of what the district will pay for retirees versus when you're active. So all questions for your local health insurance coordinator. Now, last bullet point here, we simply arrange to have the premiums withheld from your check. We can't take federal deductions such as Medicare, that would go straight to the federal government, but the premiums through your district would be taken out of your MTRS check, retirement check. Questions to ask your district is, what about survivor health insurance? If you were to pass away, would there be survivor insurance for your spouse or loved ones? Not all plans have the ability for the survivor to continue on the plan if you were to pass away in retirement. That'd be a question for your health insurance coordinator. Now, what will happen is if you retire before age 65, you'll be going on the retiree insurance for the local city or town if eligible. Once you turn 65, if you've paid the Medicare tax for 10 years or more, if you started after April 1st, 1986, changed employers or started as a new employer, which most of you most likely have started as a new employee or changed employer since April 1st, 1986, if you've been paying the 1.45% Medicare tax for 10 years or more, then you'll be eligible for Medicare upon turning age 65. You're eligible for Part A, which is what that 1.45% tax covers. In addition, you want to look into before your 65th birthday or when you retire, whichever is later, you want to look into Part B and Part C and D or additional coverage through Medicare. And also reach back out to your city or town. So you retire at age 62, you're on retiree insurance through your town, you turn 65, you go on to Medicare, you may want to reach back out to your town because you might have a supplemental plan and a lower premium that will work and coincide with Medicare for all your healthcare needs as a retiree. So a lot of back and forth between the district and then when it's time, Medicare, to figure out what the best coverage options are for you in retirement and your family. So again, Part B is something you want to look into when you're first eligible through Medicare. And you want to sign up again 3 months or look into it 3 months before your 65th birthday or your date of retirement, whichever is later. If you're working past 65, you're probably still on your active insurance. But then when you go to retire, look into Medicare coverage, in addition supplemental coverage through your district. Any questions about health insurance should be directed to your local benefit coordinator. We're going to jump into something a little bit different here, which is working after retirement. And you've probably heard in districts, there's a shortage of substitute teachers, shortage of support positions. Luckily, we haven't seen the vast majority of shortages for teachers, thankfully, fingers crossed. But more and more retirees are coming back to work. A little bit of good news for this calendar year, and this is really only through December, but the working after retirement limits have been lifted by the governor through legislation through the end of the calendar year 22. But for most of you that are going to retire in the near future in 2023, you would have to be concerned with working after retirement limits. Just to explain, if you retire from any of the 104 mass contributory retirement systems or retire from the MTRS, there's limits on how much you can earn if you're collecting a mass public pension and returning to mass public employment. If you return in the private sector, or employment in another state, public, private, or with the federal government, there are no limitations. So you can earn your mass public pension from the MTRS, and there are no limits to work in the private sector in another state, public or private, or with the federal government. Just to clarify the middle bullet point on this slide, you can go and work in New Hampshire for 10 years vest after you retire from Massachusetts and keep the benefits separate. You just can't collect benefits from two states and buy it back first, so it counts in both pension plans. But working after retirement, you can go into another state, earn your mass public pension, and earn a full teaching salary up in the state of New Hampshire after you retire. No problems there, no limits. Let's explain the working after retirement limitations. There is a separation from service rule that you would be concerned with if you're under age 62 or not retiring at your max 80% benefit. The returning to the same employer, again, only applies if you're under 62 and not retiring at your max 80% benefit. If you are over age 62 when you retire or retiring at your max 80% benefit, you don't have to worry about a separation from service rule for returning to the same employer. So if you want to return to the same employer that you retired from, and this is a federal IRS regulation, you have to be separated from service for 60 days. Works out nicely for teachers. You stop work at the end of a school year, June 30th. 60 days later is the start of the next school year. But if you're doing summer school and you want to return to the same employer, you're under 62, you have to wait 60 days. And if you're not retiring at your max 80, you have to wait 80%. You have to wait 60 days to return to that employer. Just be cognizant of the 60-day from separation rule when returning to the same employer. Doesn't matter if you're returning to a town, next to you or a different school district, the 60 days does not apply. Now, the working after retirement limitations are broken down into two categories and both apply, a time and earnings restrictions, not one or the other, they both apply. If you're working in the mass public sector and receiving a pension from the MTRS or mass contributory retirement system, you cannot work more than 1,200 hours in a calendar year. Works out nicely for teachers. That has recently been increased. 180 days times 6 hours is 1,080 hours, but I know school days are typically longer than 6 hours, so you just can't exceed 1,200 hours in a calendar year. These apply to all retirees, so it's kind of odd that it works on a calendar year, but this is calculated on a calendar year. So you can't exceed 1,200 hours in a calendar year. Your earnings calculation is the harder of the two to understand. The post-retirement earnings cannot exceed the difference between the salary being paid from the position in which you retired and the amount of your annual pension. If you've been retired a full calendar year, you can add $15,000. In the next slide, we'll explain this a little further. So you have to look at the salary being paid from the position in which you retired. That's the key figure minus your pension. Been retired a full calendar year plus $15,000. Let's give you an example. Mary Educator retired in June 30th of 2022. She was earning in her last school year, in the 2021-22 school year, $77,000 per year. But each year moving forward, she would have to get in touch with maybe her union rep or find the collective bargaining agreement to see on that salary schedule what she would have earned had she not retired. So if Mary had not retired and worked into this school year, she would have been earning $79,000 at her step and scale. That figure is going to go up the further you get away from retirement. So the working after retirement limitation works that the further away from retirement you get, the higher the amount is that you can earn. So in the 2022-23 school year, Mary would have earned $79,000 had she continued to work. We minus that from Mary's gross annual pension of $50,175, and Mary's allowable earnings for the rest of calendar year 22 in this example would be $28,825 for the year. You do have to be retired a full calendar year to get the increase for $15,000 added on. It's a one-time increase. So Mary retired June 30th, 22. That first July of 2022 to December of 2022 does not help increase her earnings. It would actually be a full calendar year after the whole 2023 calendar year, starting January 1st of 2024, we can add $15,000 on to Mary's earnings limitation. So we can add $28,825 plus the 15 would bring her up to an earnings limit of about $43,825. Now, the salary being paid for the position from which you retired does include any stipends you earned. And if you were an administrator working on a individual contract, it wouldn't be the position that or the salary being paid for your position for the new hire. It would be the position that and the salary that you retired at, plus an increase based on the consumer price index -W. So 2% through whatever that consumer price index amount is each year moving forward, because obviously when you're a superintendent, principal, they hire somebody newer, or after you retire, they're probably gonna be hired at a lower rate. So for teachers, you can look at your collective bargaining agreement to figure out the salary being paid from the position in which you retired. For individually negotiated members, you have to use the consumer price index. Last few pieces of information on working after retirement. There are critical shortage waivers. Not really in effect right now because these limits have been waived for calendar year 22. We do expect them to resume in 2023. But if a district cannot find a qualified candidate, they try to hire for a physics position or try to find an administrator and they can't find a qualified candidate, they can apply to the Department of Elementary and Secondary Education for a one-year waiver. These are one-year waivers, sometimes 6 months, to hire a retiree back, somebody that's earning a pension, and they can earn a full salary for their new position plus their pension if they are granted a waiver based on a critical shortage need in your district from the Department of Elementary and Secondary Education. If you're in Retirement Plus, you're not eligible for a waiver until 2 years after your date of retirement. You must wait 2 years. If you are granted a waiver, which is handled by the school district directly with the Department of Elementary and Secondary Education, again, you can work without limits and earn your full pension. Again, the school district would have to prove that they've tried to find a qualified candidate, cannot, and would have to apply to the Department of Elementary and Secondary Education for a waiver to rehire that retiree without earnings limitations. Again, any questions on working after retirement, feel free to contact us at geninfo@trb.state.ma.us. I mentioned earlier, we'll talk about what will come out of your benefit in retirement. What are the deductions? You might hear a teacher say, I'm retiring at 80% of my benefit, but it makes sense to retire because the take-home pay is pretty similar. When you retire, you're not paying your contributions to retirement. So you're not paying, say your contribution rate is 11%, you won't be paying 11% to help fund your retirement. You're also not going to pay Mass state income tax if you live and reside in Massachusetts, so around 6%, right? So some members say, well, if I reach my 80%, the take-home pay is pretty similar. I'm living and residing in Massachusetts, I should possibly retire because the take-home pay is going to be similar. Working will increase your salary average, and it still will be slightly higher, but again, no retirement contributions to us, no union dues typically, unless you continue to pay them as a retiree. And there's no state income tax as long as you live and reside in Massachusetts as a retiree. Of course, you're always federally taxed for any income. So on the retirement application, one of the pages you'll submit is what's called your substitute W-4P withholding. You do it as an active member, whether you want to do single, married, might change this calendar year to head of household, but you will declare your federal tax tables withholding, or your withholding, sorry, on the retirement application. I'm going to move down to the second to last bullet point. If you do move out of state, you want to check with the state's Department of Revenue that you're moving to ensure that your benefit will not be taxed. Some states do tax your out-of-state pension. Give you an example, Maine will tax part of your Massachusetts benefit if you become a permanent resident, in that state in retirement. But states like Florida, typical retirement meccas, will not tax your benefit. We have some reciprocal agreements with other states. Like you move to New Hampshire, they're not going to tax your Mass state income, Mass pension. But again, you want to check with that state's Department of Revenue, because if you move to a different state, that Department of Revenue might tax your benefit. If you started with the MTRS prior to January 1st, 1988, or you paid for a service purchase out of your checkbook, you might have after-tax money on account with the MTRS. If your annuity account balance at the time of retirement has after-tax money in it, we can't tax the entirety of your monthly pension benefit. That'd be double taxation. So what happens is there's something called the IRS simplified method or general rule. And a part of your benefit each month will not be taxable. So it's a very small tax break, but the second to last bullet point on the slide, if you intend, or sorry, the third bullet point down, many of you will have a slightly reduced taxable earnings each year because of post-tax dollars in your annuity savings account at the time of your retirement. It does take a while to spend back, but there is a calculation that's done to ensure that your entirety of your benefit is not federally taxed because you had some after-tax money. It's not like a typical 401k where you have, say, $50,000 of after-tax money or pre-tax money, and if it's pre-tax, it's taxed upon distribution. Because we're a set defined benefit plan, we have to have a special rule through the IRS that takes into account your annuity balance and then compares it to your benefit, and then a slight tax break each year moving forward in retirement. Now, the MTRS becomes your employer for tax purposes, per se. In retirement is where your payee or your payer. So by January 31st of each year, we will mail you a 1099-R form. It's really your retiree version of your W-2. It's what you use to file your taxes. Every other year, we'll do or conduct a benefit verification process to confirm you're still alive and should be receiving benefits. So watch out for that form in the mail. We'll be doing it this year. If you know a retiree, tell them to be on the lookout for that form with their 1099-R form. So by January 31st of each year, we will mail you a 1099-R tax form. Again, what you'll use to file your taxes with the IRS each year. If you're still with us, I hope you're interested in the Social Security 2 double dipping laws. If you're a member of Mass Retirees, they constantly sending updates and are hopeful that they can every year, hopefully get some reform so these don't apply to Mass Retirees at this point in time. They still do apply. There's 2 double dipping laws, one in the regards of the collection of your own Social Security benefits, the other in regards to the collection of a spousal Social Security benefit. As of today, they still apply. If you collect a Mass public pension, your Social Security may be reduced or completely offset, meaning you only get a portion of your Social Security or eliminated, depending on what type of benefit you're getting from Social Security. We're going to start by explaining the windfall elimination provision. You've heard it probably referred to as the WEP. And you're exempt from the WEP if you were eligible to retire prior to the MTRS from 1/1/86. What that means is you would have had to have 20 years of service as of 1/1/86, so you started in 1966, or you have 10 years or more at age 55. Not many members can beat this date. The only other way the windfall elimination provision would not apply to you is if you have 30 years of substantial earnings. To explain, if you collect your own MTRS benefit and your own Social Security benefit, you're subject to the windfall elimination provision. It won't be a complete elimination of your benefit. It will be an offset. This will not apply if you have 30 years of substantial earnings in Social Security. The reduction is less if you have 20 or more years of substantial earnings, which is different than credits or quarters. To be eligible for Social Security benefit, you have to have 40 credits, used to be quarters, about 10 years paying in. If you're eligible and you have 10 to 20 years of substantial earnings paying in, you'll be reduced, and it's about $500 a year or a month. So if you take home $1,000 from Social Security, the number moves each year, you'll be reduced about $500. That's a moving target. I don't know the exact number for this year. You would have to contact Social Security. So based on the offset, there's a max monthly offset. But if you have 20 years or more substantial earnings, that offset is reduced. So if you have 25 years of substantial earnings, it might be $250 reduced monthly. And if you have 30 years or more paying into Social Security, so this was your second career as a teacher, you would actually be you'd be exempt from the windfall elimination provision in that rare case to collect your whole Social Security benefit and your MTRS pension. For more information, visit ssa.gov. They have a windfall elimination provision calculator and a GPO calculator. You can create a MySSA account to get more information, and ultimately the benefits are coming from the federal government, and we do have more information in our program guide. Now, where you hear that you're not eligible to collect Social Security is due to the fact that a lot of teachers are trying to collect a spousal benefit, and this could be a complete elimination of your Social Security benefits. It's called a government pension offset, but you're exempt if you were eligible to retire prior to 12/1/1982. So if you're collecting a spousal benefit or a widow's benefit, which just means your spouse has passed and you're eligible to maybe collect 100% of their Social Security, the Social Security Administration will look at the dollar amount of your MTRS pension. So if your MTRS monthly benefit is $3,000, they'll look at 2/3 of your MTRS benefit. Let's say it's $2,000. So if 2/3 of your MTRS benefit is $2,000, they'll look at then your spousal or widow's benefit and say, is it higher than $2,000? If it's not, you're not eligible to collect any of your spousal benefits. So in a lot of cases, the spousal benefit will result in the elimination of your Social Security benefit if you're trying to collect a spousal benefit. So again, 2/3 of your MTRS benefit is higher than what you collect from a widow's benefit or spousal benefit through Social Security, you would not be eligible to collect that benefit. If your spousal benefit's higher than 2/3 of your MTRS benefit, then you would collect the difference. And again, you'd want to reach out to Social Security to figure out if you're due any benefits from the federal government. Last thing we're going to cover in today's presentation is the cost of living adjustment. I just want to say I'm glad on this slide we say it's currently 3% of the CPI. That's typically how it works. This year, for the first year, due to inflation, the Commonwealth for all retirees from the State Board of Retirement and MTRS did increase that to 5% on the first 13,000. To become eligible for a cost of living adjustment when you retire, you do have to be retired a full fiscal year. It works out nicely for teachers. If you retire at the end of a school year, June 30th, the next fiscal year, July 1st, you're eligible for a cost of living adjustment. If you retire in the middle of a year, you almost have to wait 1.5 years to be eligible for that benefit. It is granted by the legislature through the state budget process. We don't have autonomy here at the MTRS to grant COLAs. The state legislature, through the fiscal year budget process, will decide and sign into law by the governor a state budget. That'll include a COLA, hopefully, for our retirees. It's been approved every year since 1997. And again, this year they did increase it to 5% or the CPI, whichever is less, on the first $13,000 of your retirement allowance. They gave 5% on the first $13,000 this year, so it's higher than $390 this year because of inflation. They did agree to increase it. It could change each year, has to be approved by the legislature. That being said, your benefit will never go down from your date of retirement moving forward. So that's the power of your MTRS benefit. It is a lifetime guaranteed benefit. And with that, I would like to thank everyone for joining us today. We'll try to answer any questions if we have them in the chat. If we haven't gotten to your question today, please reach out to us at geninfo@trb.state.ma.us or call our contact center between 9 and 5 during normal business hours, excluding holidays. I'd like to thank you all again for attending today and for your service to the Commonwealth as an educator. Have a great night.